On October 11th, something just broke. The crypto market didn't just have a bad day. It experienced a total system meltdown. I mean, we're talking about something of truly historic proportions.
Just look at this number, $20 billion. In the blink of an eye, that much capital just poof, vanished. Yeah, that's 20 billion with a B.
And it gets crazier. Think about the people behind the money. We're talking about over 1.6 million individual investors. Their accounts just wiped clean. In an instant, a full third of the entire market was just gone. But here's the part that's almost impossible to believe. All of that chaos, it all happened in just 5 minutes. 5. So the big question is, how on earth does a third of the market get completely wiped out in the time it takes to make a cup of coffee? Well, in this breakdown, we're going to uncover the hidden forces that led to this crash, we'll pinpoint the exact trigger that caused the meltdown, and maybe most importantly, we'll share the key lesson this disaster taught every single investor.
All right, let's dive into it. The $20 billion collapse. To really get a sense of how massive this thing was, we got to put that $20 billion number into perspective.
You know, to really grasp this, you have to compare it to crypto's other so-called black swan events. Remember the 519 crash back in 2021? That was brutal, right? Bitcoin dropped 30%, but the total financial damage was about $7.5 billion. This time, the amount of money liquidated was nearly 3 times larger. This wasn't just a dip, people. It was, without a doubt, the single most financially destructive event in the entire history of crypto. So, what gives? Was this just a freak accident, a one-in-a-million event, or was the market basically a bomb, just waiting for someone to light the fuse? Let's take a look at the conditions that really set the stage for this whole disaster. Okay, so for years, the crypto market was on an absolute tear. We're talking compounded annual gains of nearly 80%. But then, in the last couple of years, something changed. The use of leverage just skyrocketed. And if you're not familiar, that's basically when traders borrow a ton of money to make these huge bets, way bigger than they can normally afford. Sure, it sent the market soaring to new heights, but it also left it standing on stilts. I mean, incredibly high and, dangerously unstable. And this is where it gets really interesting, because there was this kind of hidden battle happening behind the scenes. On one side, you had the old guard, the OGs, right? These are the long-term crypto folks who believe in these predictable 4-year market cycles. They saw the top coming, and they started to strategically sell off and take their profits. But on the other side, you had this powerful new force, Wall Street. These institutions were flooding into the market with massive amounts of money, all tied directly to the traditional stock market. So here's the crucial part. Right at the moment the market should have been having a healthy correction, with the OGs selling off, Wall Street's immense buying pressure just came in and completely overwhelmed it. All this new money soaked up the selling and just pushed prices even higher. So instead of a natural cool down, what we got was a massive, totally artificial bubble. Okay, so you have this massive bubble just primed to pop. All it needed was one tiny little trigger. And when that trigger came, well, it set off a devastating chain reaction that unraveled the whole thing. That trigger, it was the failure of a so-called stable coin called USD. Now, stable coins are supposed to be the bedrock of crypto, right? They're always meant to be worth exactly $1. But when USD depegged, which is just a fancy way of saying its value fell below $1, it sent this absolute wave of panic through the entire system. I mean, think about it. If the stable part of the market isn't actually stable, then what is? This was the match that lit the fuse. And this is how the dominoes fell, one after another. It all started with that market fear, causing USDE to depeg. But here's the real kicker. The major market makers, we're talking the big firms that keep the market running, they were using this now unstable USDE as collateral for their huge leveraged bets. So when their collateral suddenly became worthless, their systems just wanted to overdrive, automatically selling everything to cover their losses. And just like that, the biggest buyers in the entire market were forced out. All their buy orders just vanished. With no one left to buy, the floor completely collapsed. So when you boil it all down, what this disaster really exposed was the hidden fragility of this new buyer's chain. The entire buying side of the market was being propped up by these new, super complex, interconnected systems from traditional finance. And when just one of those links broke, the entire chain shattered. This whole event, it signals a fundamental and probably irreversible shift in the world of crypto. It's Wall Street's new game now. The game has changed, and so have the rules. For years, crypto was kind of its own thing, right? It existed in this isolated world, this shadow ecosystem totally separate from traditional finance. Well, you can forget about that. That era is over. Today, crypto is right in the spotlight, directly plugged into Wall Street. The money, the players, and yes, the risks, they're all one and the same now.
And that leads us to probably the most important question for you, for me, for every investor out there. Crypto was supposed to be digital gold, wasn't it? A safe haven from all the problems of the traditional financial system. But now that it's literally tied to that very system, you have to ask yourself, is it still a safe haven at all?
Okay, so what does all this mean for you? How do you actually navigate this new and, let's face it, more dangerous landscape? This brings us to your survival guide. And the key lesson here is really a piece of timeless wisdom. In investing, living to fight another day is more important than making a quick buck. And that's really the core lesson here, isn't it? In a world where these crazy institutional chain reactions can wipe out an entire market in minutes, sure, making a quick buck might seem easy. But surviving to invest in the next cycle, now that is the real skill. So let's pull some real lessons from this wreckage. First off, you have to manage your positions carefully. Understand your risk. The bigger your leverage, the faster you can get wiped out. It's that simple. Second, remember that survival is the ultimate goal, period. Third, and this is a big one, these moments of maximum fear, historically, they've been some of the best buying opportunities ever, but only if you have the capital and the guts to do it. And finally, think long-term. Think in years, not in minutes. Because panic is always the most expensive trade you can make.
So really, the true test of an investor isn't just knowing when to get into the market. It's having the discipline to know when to get out. So I'll leave you with this question. When the crowd is at its absolute loudest, when everyone is screaming to buy and the euphoria is at its peak, will you be ready to quietly walk away?